Hello, finance enthusiasts. Welcome back to our channel. Today, we're diving into the world of investments. If you're a beginner, this is the perfect place to start. Let's break down the basics of stocks, bonds, mutual funds, and real estate. First things first, what exactly is a stock? In simple terms, when you buy a stock, you're buying a piece of ownership in a company. Think of a company as a pie. Each stock is a slice of that pie. The more slices you own, the bigger your share of the company. Now you might wonder, why even buy stocks? Two main reasons. First, capital appreciation. Second, dividends. Capital appreciation means the increase in the stock's value over time. Dividends are a portion of the company's profits paid to shareholders. Alright, so how do you get your hands on these stocks? You'll need a brokerage account. Think of it as a special online bank account where you can buy and sell stocks. There are many platforms out there, so you'll want to do your research to learn which is best for you. Here are a few sites and apps that could help: Investopedia, Stockbrokers.com, Robinhood, TD Ameritrade, and E-Trade, among others. Like all investments, stocks do come with risks. The stock market can be volatile, prices can skyrocket, but they can also plummet. It's essential to understand and be comfortable with the risks. One way to manage risk is through diversification. Don't put all your eggs in one basket. Spread your investments across different companies and sectors. Before diving in, research is crucial. Stay updated with company news, financial reports, and market trends. Knowledge is power, and in the stock market, it's also profit. Here are some additional websites and apps that can help keep you up to date: Yahoo Finance, Bloomberg, Seeking Alpha, StockTwits, and CNBC. Next, we have bonds. At its core, a bond is a loan, but instead of you borrowing from the bank, you're the one lending the money. In exchange for your loan, the issuer of the bond promises to pay you back with interest at set intervals and return your principal when the bond matures. Bonds come in different types. There are government bonds, corporate bonds, and municipal bonds, each with its own risk and reward profile. So why consider bonds? Bonds are often seen as a safer investment compared to stocks. They provide regular interest payments and can be a steady source of income. Let's get familiar with some bond lingo. Principal is the amount you lend and will get back at maturity. Coupon rate is the interest rate you'll receive. Maturity date is when the bond expires and your principal is returned. And yield is your actual earnings from the bond, which you can change based on the bond's market price. Like all investments, bonds aren't risk-free. Interest rate changes, credit risk of the issuer, and inflation can impact your bond investment. It's essential to understand these risks before diving in. Ready to invest in some bonds? Here's how. You can buy bonds through a brokerage account directly from the issuer, or a bond fund, which pulls together many bonds. A few places include the U.S. Treasury Direct, Bonds Online, Bonds.com Mobile, and iBonds. Next, let's talk about mutual funds. A mutual fund pulls money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. It's like a collective investment journey. Why consider mutual funds? They help shield risk because they provide diversification to spread your risk across multiple assets. They provide professional management where experts handle the buying and selling, and liquidity, so you can easily buy or sell your mutual fund shares. There are various types of mutual funds. They include equity funds, where they're invested mainly in stocks, fixed income funds focus on bonds, and international funds where you invest outside your home country. It's crucial to know about fees. Most mutual funds charge management fees, which cover the cost of managing the fund. Always check the expense ratio, which indicates the percentage of assets used for fees. You might hear about active and passive funds. So what's the difference? Active funds are managed with the goal to outperform the market, but there are higher fees. Passive funds track a specific market index and have lower fees. If you're ready to dive in, you can invest through brokerage accounts, banks, or directly with a mutual fund company, but always research before choosing. A few resources include Morningstar, Vanguard, Fidelity, and Charles Schwab. While diversification reduces risk, market fluctuations can still impact your investment. It's essential to align funds with your risk tolerance. Mutual funds offer a gateway into the investment world. They provide diversification, professional management, and ease of use. But remember, always do your due diligence, understand your financial goals, and consult with a financial advisor when needed. Alright, lastly, real estate. Real estate investing is more than just buying a home to live in. It's about purchasing property to generate income, whether through renting, reselling, or both. Real estate investing is diverse. Let's explore options. First, there's residential. Think homes and apartments. Then there's commercial. That would be offices and retail spaces. There's industrial, which would include warehouses and factories. And then land, which is raw, undeveloped land waiting for a purpose. So why venture into real estate? Real estate can offer passive income, appreciation in property value, and a hedge against inflation. Plus, it's a tangible asset you can see and touch. One of the biggest hurdles investors have is financing. Most investors don't buy properties outright. They use mortgages. A good credit score, stable income, and a down payment are crucial. Like previously mentioned, every investment has risks. With real estate, you might face market downturns, bad tenants, or unexpected maintenance costs. It's vital to be prepared and informed for these situations. One unique aspect of real estate is leverage. With a 20% down payment, you can own 100% of a property. This means you can control a large asset with a smaller amount of money. You've probably heard this before, but the location of your property can make or break your investment. Research neighborhoods, future developments, and local amenities. Real estate investing is a journey of learning and growth. Start small, do your homework, and always be ready to adapt. The world of real estate is vast, and with dedication, it can be a fruitful venture. That's it for today's Investing Basics for Beginners. If you found this video helpful, don't forget to like, share, and subscribe for more finance insights. Until next time, happy investing!